Quick question. What if every bubble, from the late 1990s to 1989 Japan to 2008 housing, started the same way, and today's market is humming that tune? You've seen the headlines. Prices are going up. New millionaires. Friends who never invest ask what to buy. Bubbles don't begin with panic, they begin with comfort. Money feels easy, the story feels new, and risk feels like someone else's problem. That is when the clock starts. So let me ask you coffee table questions. What pushes prices from reasonable to ridiculous? Which warning light flashes first? Why do everyday investors ignore it? And where are we right now on that curve? The dotcoms, Japan's land boom, and housing once climbed? In the next few minutes, I'll show 4 repeating ingredients: easy money, a shiny narrative, borrowed fuel, and leadership squeezed into a small group. We'll see the same loop show up on charts of rates, IPOS, property, debt, and margin balances. Once you see the pattern, you will realize how far along we are in the next bubble right now. Let's get right into it. There's a playbook markets can't quit. If booms feel familiar, this is why. It has 4 ingredients. First is easy money. When interest rates fall and credit is loose, dollars go searching. Companies raise cash cheaply, investors feel bolder, and lower payments make risk look smaller. Second is a shiny news story. In the late 1990s, it was the internet. In 1989, Japan, it was land. In the mid-2000s, it was housing that always goes up. Today, it is artificial intelligence and platform scale. A good story turns price into its own proof. Prices rise because the story is good, and the story feels right because prices rise. Third is leverage, meaning borrowed fuel. Margin lets you buy more than you can afford. Creative loans help households stretch. Leverage is a speed booster. It lifts gains and compresses time, then brings losses all at once. Fourth is concentration. A small group of leaders carries the index while the crowd cheers. The market narrows to a few names or one hot sector, and attention misses weak spots underneath. These 4 feed each other. Easy money gives the story room to grow. The story justifies leverage. Leverage chases the winners and pushes concentration to extremes. Then, one of 2 things happens. Money tightens or growth fails to meet the story. Confidence hiccups, lenders step back, and gravity returns, pulling all stock markets back to the ground. Michael Burry often points to this loop, especially the leverage piece. He also warns that passive flows can hide fragility when money funnels into the same winners again. Keep that checklist in mind as we lay charts on the table. Policy rates sliding, IPO pops, land and home prices surging, debt service pressure rising, and customer margin balances climbing. With those gauges set, let's rewind to the late 1990s, when the internet turned into a religion and the NASDAQ became its altar. The late 1990s felt electric. The internet was going to change everything: how we shopped, worked, and even how we thought. Investors poured into anything with a .com at the end of its name. The idea was simple. If the world was moving online, profits would eventually catch up to prices. But as we now know, prices got there much faster. Here is the simple version of what happened. Money got easier. The internet gave us a perfect new era story. Investors borrowed to chase it, and the market's leadership squeezed into hot tech. The NASDAQ composite was climbing almost straight up into early 2000, then snapping lower. That near vertical ramp is what a story looks like when price outruns profit. The gasoline was IPO fever. On the IPO chart from Professor Jay Ritter, notice 2 things. First, the count of new listings surges. Second, average first-day returns explode into the 60% range, which means Wall Street is leaving huge money on the table. In plain English, deals are being priced below where the crowd will pay, because the crowd is living on adrenaline. That is a market choosing speed over diligence. Why did this cause trouble? Because the story began to set the valuation, not the cash flows. When funding conditions tightened and the growth curve missed the dream, confidence cracked. The same borrowed fuel that lifted prices made the drop faster. It is not that the internet was fake, it was real, just early, and the pricing acted like the future had already arrived. Now, look just beneath the price. Many new issues had little revenue and profits were years away. Analysts talked about eyeballs instead of earnings. As the effective federal funds rate climbed and capital turned picky, flimsy models lost funding. Margin calls bit. The rally's center of gravity moved from story to solvency, and the index finally let go. Two quick tells from that era still matter today. When first-day pops get wild, discipline is fading. When an index rises on expectations while profits lag far behind, gravity is loading the spring. Keep those tells in mind as we switch scenes to a different stage where collateral, not clicks, drove the loop. 1989 Japan. And it started with a story that seemed unshakable. Land in Tokyo was the most valuable asset in the world. At the very peak, people said the grounds of the Imperial Palace were worth more than all the real estate in California. Behind that story was easy money. After the Plaza Accord in 1985, Japan's central bank cut rates to weaken the yen. Credit flooded the system. Banks lent aggressively against land and prices began to surge. The higher the land went, the more collateral banks thought they had, which meant even more lending. It was a self-reinforcing loop, or the collateral loop. Watch the BIS chart of Japan's residential property prices rise into 1989, and then stall for years. The index peaks in early 1991, around 182.8. Fast forward to today, and the index still sits near 140 points. That's more than 30 years later, and still about 20% below the peak. The line climbs steeply, then goes flat like a heart monitor that lost its pulse. The problem was not just price. It was how price was linked to lending. When land is the asset and the collateral at the same time, a small change in credit turns into a big change in values. Once the Bank of Japan tightened and lenders pulled back, the feedback loop reversed. This did long-lasting damage. Companies spent decades repairing balance sheets. Households learned caution by force. Markets can stay muted long after the headlines move on. This is what makes Japan's bubble different. Instead of crashing in a blaze, it deflated slowly, leaving households, banks, and investors stuck in limbo. Stocks never fully recovered either. The Nikkei index only recently returned to its 1989 highs. One important layer matters. Banks did not just lend. They lent against rising land values to hit growth targets. Cross-holdings kept pressure low until it wasn't. When the Bank of Japan raised rates and credit norms tightened, refinancing got harder. Projects paused, prices softened, and bad loans surfaced. The aftermath lasted decades. You would think we are rational beings. We would not repeat that. Hold that thought. Because the same engine and collateral logic crossed the ocean and drove the 2008 housing bust. To see it clearly, we do not start with house prices. We start with the monthly payments that families had to make and how those payments swelled beyond paychecks. The housing bubble carried a comforting story. Your home is your safest investment, and prices always go up. Lenders built products to fit the story. Teaser rates, low documentation, and interest-only loans. Wall Street bundled those loans into mortgage bonds and sold them around the world. As with any good story, confidence ran ahead of cash flow. On screen, the Case-Shiller U.S. National Home Price Index shows prices peaked in mid-2006 around 184. Payments as a share of income were stretched. When teaser rates reset, the math broke for millions of families. Housing demand fell, forced selling began, and the dominoes reached the banks. By early 2012, the index had collapsed to about 134. That's a nationwide decline of roughly 27%. Today, the index has surged to over 331.5. But the price drop alone wasn't the real killer. The real fuse was affordability. The household debt service ratio, which measures debt payments as a share of disposable income, spiked to about 15.8% in late 2007. That meant households were spending nearly 16 cents of every dollar just to service debt. In simple words, monthly payments outran paychecks. That is when trouble shows up in the real world. Fewer bids, fewer approvals, more forced sales. Once lenders saw rising delinquencies, they tightened, which pushed prices down, which raised loan-to-value ratios, which forced even more tightening. The loop fed on itself. Here is a kitchen table way to picture it. A teaser rate is like paying for a truck with cheap months up front. The full payment arrives later, and the gap eats into groceries. Multiply that by millions of loans, and you get a nationwide financial squeeze. That is how a price story turned into a funding crisis. The math stopped working everywhere. So, where are we right now? The headlines today sound very familiar. Artificial intelligence is the new internet. It promises to change everything from search engines to healthcare. A handful of mega-cap tech names dominate the market, accounting for between 30 to 40% of the S&P 500. After years of swings, policy has shifted, liquidity pulses, and investors feel braver. And investors are leaning in with borrowed money. Again. Here is what you can watch without a PhD. First, customer margin balances. Take a look at FINRA customer margin debt. In August, margin balances reached $1,059 billion. That's higher than the peak back in 2021 and more than double where it was a decade ago. Leverage is fuel. It accelerates rallies on the way up, but it also deepens sell-offs when the tide turns. Meanwhile, the concentration is flashing red. According to Goldman Sachs and S&P data, the top 10 stocks now make up nearly 34% of the index. Just 4 giants, Microsoft, Apple, Nvidia, and Alphabet, have recently accounted for almost a quarter of the entire S&P 500. That's extremely close to the dotcom era when Cisco, Intel, and a few others carried the index higher before the crash. And what about valuation? Schiller's CAPE ratio recently sat in the 40s. That's above historical averages and right in the zone where past bubbles have inflated. Individually, none of these signs proves a bubble. But together, easy money still lingering in the system, a powerful AI narrative, record leverage, and extreme concentration. They mimic perfectly with the classic. The point is not to be gloomy, it is to be honest about how fragile a narrow leveraged market can be. We do have real businesses with real profits leading today, which is different from the late 1990s. But the loop, easy money, shiny story, leverage, concentration, still hums. If you can spot those notes early, you can lower stress, manage risk, and stay curious. Here is the comparison that matters. Unlike the dot-com boom, several leaders today throw off cash. That helps, but it does not cancel the loop. When the top 10 names carry a share of returns, expectations stack up on a narrow shelf. One wobble up there can shake the whole room below. To keep that in check, use a simple monthly checklist. Think of it as a cockpit scan before takeoff. Here is your simple checklist. Ask first about money. Are financial conditions easing or tightening? If the cost of money is falling and liquidity is plentiful, that is a tailwind. If it is rising, be careful with stories that depend on cheap financing to make the math work. Next, listen to the story. Does the narrative explain price, or is price explaining the narrative? New era language is a clue. When the future is treated as prepaid, expectations can detach from reality. Then look for leverage. Are customer margin balances climbing? Are loans getting looser? Leverage shortens cycles. It turns dips into rushes and rushes into stumbles. Rising leverage does not cause a crash by itself. It just makes the landing harder when something shakes confidence. Next, check the concentration. Are a handful of names carrying the index? Narrow leadership can be fine, until it isn't. If 1 or 2 leaders stumble, the whole index can wobble. Finally, keep one valuation yardstick in view, like the long-run CAPE context. It does not time markets, but it tells you whether expectations are already rich. If your dashboard shows easy money, a glowing new era, leverage rising, and leadership narrowing, while valuations look full, you know the setup. That is when you slow down, ask better questions, and prepare for surprise. Bubbles rarely die of old age. Something nudges them. Liquidity tightens. Financing turns off. The story stops delivering. One headline becomes one missed quarter. Then one lender says, "Not now." And the loop runs in reverse. So you need to know how to play defense too. It does not mean hiding under the bed. It means building habits. Spread your entries over time so one date never decides your fate. Keep some liquid cash so when the stock market comes down, you can buy at a bargain. Be careful with leverage. Borrowed money changes a bad day into a worst one. Diversify by cash flow, not just by ticker. And pre-decide what would make you trim, add, or sit still so you act with a plan, not a pulse. Most of all, stay curious. When you hear "this time is different," ask how different and why. If you can get an answer to that, good. If you don't, you know what to do now. The stock market is getting chaotic right now. And if you want to see what smart investors like Michael Burry, Warren Buffett, Howard Marks, and Bill Ackman are doing about it, click the video on screen.